Hello, everyone. Welcome back to the examination series for Cambridge Economics IGCSE. Today, we are going to be looking at May-June 2012, and we are going to be looking at Variant 1, Paper 1. If this is your first attempt at exam papers, you would probably just want to run this video through, but it would be a good idea for you to pause the video from time to time to have a look at the questions before I proceed with the explanations. I will be going through all three variants, including and also the Indian variant, which is the March series. I will be also going through the winter papers. So this would probably be a little bit more lengthy as opposed to the other ones, because I would probably take some time to explain the background, especially in certain topics. Yeah. This will be a little bit different from the videos where I actually would explain according to topics. So if you are a little bit confused over the explanations, please feel free to drop a message or drop a comment, and we can discuss further, right? So as suggested, you could probably pause the video here before I start talking, elaborating any further. Which combination of resources and ones would cause the economic problem? So for you to answer this question, you probably need to understand and first tell the examiner what is the economic problem. It'll be a good habit if you could actually mess up your exam paper, so to speak. Yeah. What I usually do as a habit, and I've encouraged my students to do this over the years, if you could just highlight, so what is the economic problem? We know this to be scarcity. And this is a definition question. So if you don't know your definition, you wouldn't be able to answer this one. Scarcity basically talks about where you have unlimited resources. You've got limited resources and you've got unlimited ones. Yeah. So normally what I would do as a habit, whether or not it's required by the question, would be to write down what I know about the topic by the side. I mean, I wouldn't need to write an entire thesis or an essay, but it helps. And in class, if a student were to do this, I could actually correct the misconceptions along the way. So good practice for you to do this. And when you're practicing, for a start, probably you want to refer to your resources and your materials until you get a better hang of things. Right. So as I said, limited resources and unlimited ones. We know that we said it's limited resources, right? So we know that C and D are definitely out of the question already. So cancel the answers. I know you know, as I always tell my class, I know you know, but good for you to actually eliminate the options on paper, because many a time students have, to their dismay, selected the wrong answer, even though they knew it was wrong. But in a moment of panic, they would have circled something, or their minds were already moving on to the next question, and just circle the wrong one, out of distraction. So block out answers which are wrong, cancel it. Right? It's a technique that my parents have taught me from primary school. So it's a very simple technique, but it eliminates the possibility of careless mistakes. Yep. So limited resources and unlimited ones. So we already know from canceling, that your answer is B. Right? So bit longer than necessary, but here are some tips along the way that you could practice. What does economists mean by capital? So here we are talking about our factors of production, land, labor, capital, enterprise. So let's go through. Man-made goods that do not directly satisfy human wants. So it is indirect because it produces your capital. What is capital referred to in economics? It's a little bit different compared to other syllabus. Capital here refers to your machinery and equipment. Yes. So this machinery and equipment is not the final product that your business ultimately wants to produce. Yeah. So let's say you are publishing a book. Okay. You need some materials in order to publish that book. And us being in the 21st century, we probably use a laptop as the easiest means of getting things done. You use a laptop, you use a phone, desktop, whatever it may be. So you are not producing a laptop. You're not producing a handphone. You are producing a book. But the laptop or the desktop, whatever it may be, is your means to achieving that book. So it is an indirect means of helping you. So the capital, your machinery, your equipment that helps you achieve this would be the laptop or the desktop or the handphone, whatever it is. Yeah. So indirectly, it helps you to achieve your end goal. So man-made goods that do not directly satisfy human wants, you can see that that would be the answer. Another thing to point out about capital here, if you can look at option B, money used to set up new businesses and expand existing businesses. No. In economics, we don't refer to capital as money. I know we do that in a general context, day-to-day conversations, business studies, you refer to money as capital. In economics, no, because you go back to your definition. Indirect goods, your machinery and equipment that helps you to achieve, to produce other goods and services. So money can help you to buy these goods and services. Money can help you to buy this laptop, buy the handphone, but it doesn't help you to make the book. You understand? You need something, you need some resources to make that book. Trees to print, to make paper. You need, staples to bind the book, something, but it's not money in itself aids you to buying all these things, but it is not machinery and equipment, right? So it cannot come under capital. Okay, it helps you to purchase at the very best. Natural resources that will not be replaced. Natural refers to land. Okay, if you recall, land does not refer to the ground in economics. It refers to anything that's natural. It could be something which is over the ground, on the ground, under the ground, doesn't matter, as long as it is something natural. So that would be land. That will not be replaced. That one refers to non-renewable resources. So it could be things like petroleum, could be things like diamonds, things that takes years to reproduce. Okay, years, when I say years, it means hundreds of years, thousands of years, fossils, things like that. Yeah. The ability to earn profits by combining resources to produce goods that would refer to enterprise. It's the only factor of production that can, its job is to combine the other three, land, labor, capital. And ultimately, end of the day, it takes the risk when it combines these resources to produce, hopefully make a profit. Okay. Number 3. A student leaves school. This is a highly popular question. They have asked this several times over the years, and it has even been repeated in the A-level paper. A student leaves school and decides to spend the next 2 years at a college to improve her qualifications. What is the opportunity cost to the student of taking this decision? So opportunity cost refers to the next best alternative foregone. That is the definition that we are given. Right? Next best alternative forgot, meaning to say that at best you had 2 alternatives. And that's the theory. You have got 2 alternatives, choice A, choice B, alternative A, alternative B. All right. What happens is that you are looking at the 2. You can't have both because remember, we have got limited resources. You got to pick, right? Whether it is due to limited time, whether it is due to limited resources, but you got to pick, right? So out of the 2, let's say you select choice A, alternative A, because it is the best, for whatever reason, it's the best for you at that point of time. You have to let go of another resource. So that's alternative B. So the next best alternative is choice B. You have let it go because you have picked choice A. You couldn't have both. So you picked up choice A. You let go. What was foregone? Alternative B, choice B. Got me? So here in this question, you have got a student who can either go to school, go to college, or she goes to work. She has decided, for whatever reasons best known to her, she has decided to go to college. So what has she foregone? Going to work. Obviously, if you look through the options down here, they didn't tell you that. They gave you, some other answers. So let's go through one by one. The cost of the course fees at the college. Now she has chosen to go to college. So obviously, every choice that you make comes with consequences. In this case, this is a monetary cost. Monetary cost and opportunity cost are two different things. She has gone to college. Obviously, she needs to pay fees. Yep. So that's something that comes with the choice that she made. The increase in job opportunities she will have as a result of her extra qualifications. She had choice A, choice B. Both have got consequences. Some are beneficial, some are not. If you look at B, she has gone to college, she has qualified, so now she's entitled for better opportunities. So those are the benefits from the decision that she has made. Yep. See the lost production due to her not being in work. See, again, you're looking at the choices that she made, so the consequences to her. She didn't go to work. Does she lose production? No. The firm loses the production because she didn't go to work. But we're not looking at what the firm is losing. We're looking at the choices that she made and what are the consequences from there. Yeah. So that is the opportunity cost due to her not being in work. The money she would have earned if she had been in work for the next 2 years. So that is the sacrifice. If she had worked for the 2 years that she was in college, she would have earned some money, but she chose to go to college. So she couldn't earn that money. That is the sacrifice, or that is what she has foregone. So the answer is D, Denmark. What is found in a mixed economy but not a free market economy? So for this, you got to know, to answer this question, you got to know what the three economic systems are, and you also need to know what the characteristics are, right? So in a free market economy, your two parties or your two agents, economic agents, are your consumers as well as the producers. Command economy is mainly the government. You are there, you exist, but everything is mainly decided by the government. Mixed economy is where all three are present, consumer, producer, as well as the government. However, what you are looking at here would be, what shall I say, will be your, you're looking at the characteristic of a free economy. So when you have the government involved, the whole thing with a mixed economy is that, yes, the government, the economic agents, that is your consumer and producer, do they would actually be able to interact as per normal, right? But what is different about the mixed economy and the free market is that the government is present in the mixed economy and they would actually be monitoring. The free market has got no element of control, no element of monitoring whatsoever. You're free. That's why the word free is there, right? You're free to do as you please. You can sell whatever you want, how much you want, at whatever price you want. It's between you and the producer, the consumer and the producer. But in a mixed economy, the government would decide, for example, that you could not sell, you cannot sell cabbage for 1,000 ringgit. You cannot sell drugs freely on the street. All right. The laws and rules would differ country to country, and that really depends on the background, the culture, the history of how involved the government is in that particular nation. Right? So most countries in the world, as you know by now, would be operating on a mixed economic status. But what will be different about, say, Asian countries, you will find the government's a little bit more in control, right? So you can see, for example, if it is how free the press is, that would give you an idea of how involved the government is. But generally, the government is present in all economic situations to monitor and to look after the welfare of certain quarters in society. Okay, so that's a little bit extra, but here we are. Banks. Now, banks, unless you are the national bank, you are profit making to an extent. You have to be. You have to pay your staff. You have to be able to pay interest. You have to be able to generate loans for people. So for the large part, you got to make profit somewhere. So profit making exists both in free market and the mixed economy, but in the mixed economy, you would be under control to some extent. Yeah. Division of labor, that is more towards how you as a firm would divide the task among your employees, wouldn't it? So I put down here both the mixed and the free market. It does exist in command, but very, very limited. So that is why I excluded command economy from this answer. But it would exist very mildly there. Price control. Now there is a control down here when the element of control does not exist in free market. So the idea of price control, if you remember, it's maximum price and minimum price. So only these two as far as the syllabus is concerned. So the reasons behind that would be, if it is maximum price, would be to look after the welfare of consumers, because we limit how high the producer might set the price. And that is not for all goods. Yeah, we don't go for a Lamborghini and say, okay, you need a maximum price down here. That's a different category altogether. We limit it in terms of necessities. Yeah, so that people would be able to live. They can, they are able to afford basic food, basic housing. Yeah, to take care of your basic needs. And minimum price, of course, is to look after, on the other hand, the welfare of producers. Yeah, we don't want to bully our producers. We want our, if you go into business, you need to make a decent living as well, right? So especially in certain industries, right? Okay, like cottage industries, not so much, but say, for example, in Malaysia, we have our festivals, right? Many festivals, and where you would find basic things, chicken, onions, okay, those tend to soar extremely high during things like Hari Raya, Deepavali especially. So you will find that because there is a large number of partying, a lot of functions that happens during this time. So these are the commonly sought out things, chicken, onions. Okay, so specifically you'd find that there are price constraints on the how high or how low that these the prices that should be set. Okay, even time to time the government does monitor, and simple things like onion, garlic, the government would put a maximum price and say, okay, that's as far as you go, right? Because otherwise nobody will be able to cook. Same thing for um, cigarettes in this country. The government does not say you can't sell cigarettes. Okay, and that's a whole different that's another big explanation why that is the case. Why don't you just ban cigarettes altogether? But anyways, just for purposes of this explanation here, the government puts a minimum price on cigarettes. That means now this is not the welfare of it's not for the welfare of your cigarette sellers. This is more towards to limit the cigarettes that are sold in the market. So yeah, there is a minimum price at which cigarettes must be sold. Any of these things which are violated, maximum or minimum price, if the producer or the seller violates them, especially the seller, they can be penalized, right? Either there's a penalty which is imposed, or there's a fine which is imposed, or they can even go to jail, right? Right. So control doesn't exist in the free market. That's your answer there. Profit motive, as I said earlier, it would exist in mainly mixed and free market. Command economy is largely controlled by the government, and it's more welfare based. So we're not so worried about profits there. All right. Number 5, a large shop selling clothes opened in town. Its prices were much cheaper than other shops selling similar items. Okay. And as a result, many more customers came to the area. Now, this story-based question is quite popular in IGCSE. So when you read through, you must be able to pick out when in a particular sentence, what concept are they trying to highlight. Okay, so if you look at external benefit, okay, external benefit is representing positive spillover. So it's a market failure, yes. Externalities shouldn't exist in a perfect market. When you have external benefit, this is something that has not been taken into consideration, but there are positive spillovers. So you didn't take that into account when you set your pricing, when you set how much you are selling your products at. Okay. Now, here the large shop has opened. They are selling clothes. They are selling at a much cheaper price than other competitors. Now, as a result, many more customers came to the area and they also visited restaurants near the shop. The restaurants reported a 10% increase in sales. Did the restaurants do anything? No, but they benefited as a result of the large shop which opened up. So, in which sense, they have benefited externally. Yeah, so there's been a positive spillover to somebody else, and somebody who was not involved in the decision whatsoever. Yep, so that's where you have your external benefits. You also have yeah, okay, so that would be the answer. Sorry. Inelastic demand, we don't know actually, but if you look at what they're mentioning here, this large shop is selling clothes. There are other shops selling similar items. So chances are that this would be elastic demand. People would be price sensitive. Yeah. As a result, many more customers came to the area. So that means people are price sensitive to the clothes. The moment you sell something a bit more cheaply, everybody goes running. That makes it elastic. That makes it sensitive. Okay. Market failure, yeah, because to an extent, but it's not the main idea. It's not been highlighted here per se. Okay. Because ultimately, if you go through the story, there's no focus on the issue of optimal output. The whole problem with market failure is that you did not cater to fulfilling the needs of everybody in the market, everybody in society. That is market failure. Okay, so nothing. If you go through these concepts here, nothing of that sort has been stated. And then when you come to perfect competition, not possible because perfect competition deals with homogeneous goods. Yep. So if you look at the second line, it says the shops were selling similar items. So similar items deals with a different market. This is not in the syllabus. This is monopolistic competition. So you've got perfect competition, monopolistic, oligopoly, and monopoly. But for syllabus purposes, we only have perfect and we have monopoly. Okay, they're two extremes. In the case of perfect, it must be homogeneous goods, exactly similar to each other. So say a loaf of bread. Even then, I will find this difficult to say in today's world because you got a few bread sellers, not many, but a few. Okay. Say if you're selling toothpaste, even then we don't really. So it's a very theoretical market. Even if I say toothpaste, you have got different toothpaste on the market. So the moment something is differentiated, it becomes monopolistic. Yeah. So if I was talking about toothpaste, then you have toothpaste, which is for kids' toothpaste, strawberry flavored toothpaste. You have smokers' toothpaste. You have toothpaste, which is supposed to keep your mouth fresh for 12 hours. Toothpaste that's supposed to keep your mouth fresh for 24 hours. Different flavored toothpaste. So the moment you have those mild differences, it becomes similar, right? So in which case you are going into a monopolistic market. All right. What is not held constant in constructing a demand schedule? So demand schedule, if you look at your textbooks and your resources, when they are teaching you the concept of demand, you would be given a table. And in the table, you have two columns, which is price and quantity demanded. That table that tells you at what price, how much is being demanded, what price, how much is being demanded, that table refers to demand schedule. It's called a demand schedule, sorry. Okay. Now, to construct a table like that, you need everything else to remain the same, which is why in economics, you study the concept of ceteris paribus. Okay, the Latin terminology, all else remains the same. You need everything else to remain the same in theory because you're trying to illustrate the concept of, if my price were to increase, how does my buying change? If my price were to decrease, how does my buying change? So for you to study that, theoretically, everything must remain the same. Okay. So for example, if I were to say, I use the example of umbrella simply because it's rainy season nowadays. So for example, if I say umbrella is being sold for 5 ringgit, okay? So if I reduce the price of umbrellas to 2 ringgit, I want to know how many extra people would buy, how many more people would buy the umbrella. Because this helps me to do a lot of, take a lot of other decisions. I need to know what's the sensitivity of people towards that purchase, okay? Now, for me to know this, everything else must remain the same. That means I'm just purely trying to say, if from 5 ringgit to 2 ringgit, what is the change? This is to say that if the weather does not change, if there is no trend on umbrellas right now, there is no movie star that is promoting a particular umbrella. You know, there could be different things that make you want or not want to buy something. So say, for example, if you look at if you look at the screen which I've drawn up right now, you can see that at different prices, the red line highlights that at different prices, there's a different level of demand. Okay. But if, for example, say, for example, okay, I'm using this example because it is something that I'm planning to do. My brother is a Star Wars fan, right? And there is this umbrella that's being sold right now that has the stem of the umbrella, which looks like a lightsaber. And it's a bit, of course, it's a bit more expensive than the regular umbrella. But let's say a Star Wars movie has been recently released. Okay. And this umbrella now gets highlighted that there is such an umbrella. So did the price of the umbrella change? No. But because a Star Wars movie is trending, if you can look at the screen now, you see the price of the umbrella did not change. But due to the Star Wars movie trending, everybody is now, oh, let's go and get this umbrella. It looks cool. It looks like a lightsaber. You see what's the difference? It's different between saying that the price of the umbrella had a discount. That would be on the same level of the same conditions. If the price of the umbrella were to experience a discount, you would see the number of purchases would increase or decrease accordingly if there's no discount. Okay. But say there's a movie trending, this is what's going to take place. So everything else would differ. Taste of the consumer. So that, say, for example, the movie. Incomes of consumer. Price of umbrella does not change. But now I am earning a bit more. So I'm able to afford this umbrella. So the Star Wars umbrella, for example. Okay, again, as I said, it's a lot more expensive than a typical umbrella, which you could get, say, maybe for 8 ringgit, 10 ringgit. But because, let's say, I've got a promotion, so now I'm able to afford this very cool looking umbrella, right? So that would cause you to buy now that you can afford it. Now, where a lot of students would actually make a mistake would be B, the price of complementary goods. The example which I typically give when I teach this topic in class would be McDonald's and Coca-Cola. Okay. McDonald's, Coca-Cola, and the complementary good would be McDonald's French fries, simply because I like those two things when I go to McDonald's. Okay. I must have hot, salty French fries and cold, fizzy Coca-Cola. Okay. Right. Now, complementary goods are goods which are consumed together. It is used together. And that's basically what I do when I go to McDonald's. Okay. I must have my hot fries and hot salty fries and cold fizzy Coke. Right. And why particularly McDonald's French fries? Because that is something that my Chihuahua, she only eats McDonald's French fries. No other French fry is acceptable for her. You can offer her the best in town, but no. Okay, it has to be McDonald's hot salty French fries. Okay, for that fuzzy pot. Now, German Shepherds eat it. My German Shepherd eats everything. That one is a different story. So let's say that McDonald's now tells me Valentine's is coming up. So we're giving Coca-Cola, we are selling our drinks at a discount. So I'm able to buy more Coca-Cola because the drinks are under discount. Okay, so that would be something like this. Okay, if you can see you would see the red lines. Price of Coca-Cola is cheaper. I buy more Coca-Cola. But because I'm buying more Coca-Cola, I end up buying more French fries. I wouldn't have done it if not for the price of Coca-Cola. So the graph for Coca-Cola would look like this because the price of Coca-Cola has become discounted. So I buy more Coke. But the graph for French fries would look like this. I'm buying more French fries, not because the price of French fries changed, but because the price of Coke has changed. And I buy those two together. If I'm buying Coke, I'm buying French fries. In your textbook, you would see something like cars and petrol. I'm buying more, because I'm buying more cars, I end up buying more petrol. It goes together. So if cars are discounted, it would look something like this. The petrol graph would look something like this. So here, in any question, you need to look at what exactly the examiner is asking for. And then what graph are you illustrating in your options? Okay. Number 7, a shop sells chocolate birthday cakes. When the price was $15, it sold 40 cakes. It reduced the price to $10 and sold 60 cakes. This question is talking about elasticity of demand, yeah? So that I derived after I went through the answers, but okay. So that's why you see all these little calculations on the screen. Let's go through the options first, and then we can go through the calculations. The firm will make less profit because the price has fallen. First and foremost, we never discuss profits unless we know the cost. We know the revenue from what they are giving in the text, but we don't know the cost. They have not told us. They're telling you how much they sold the birthday cake for, but how much it cost to make the birthday cake, I don't know. So unless I know that, I cannot legitimately answer the question, the firm will make less profit. If they say may, there is a question though. If it says may make less profits, yes, that you could take that as an answer. If anything else is not fitting, you could take that as an answer. But otherwise, generally avoid these answers because we don't know. Unless they mention about costing, we cannot legitimately answer about profits. Okay, unless it's a dire situation, everything else is wrong, don't take that answer. Okay. The firm will make less profits because the price has fallen. I don't know. Okay. 1. 2. Even if I were to answer this in terms of revenue, when a product is price sensitive, and this involves us going to discussing about what is elastic, what is non-elastic, and then what is the impact of changing the prices in those situations. So when it is something which is elastic, that means people are price sensitive towards the product. Okay, so it's saying like the difference between Starbucks offering a discount in their coffees versus your school cafeteria offering a discount in coffees. Yeah. If your school cafeteria offers a discount in coffees, are you going to buy a lot more? Maybe you might buy 1 or 2 cups. Whenever there's a discount, there's always people buying more of that product. Yes, we accept that. But the question is how many more people are buying, or how much more are people buying? So if Starbucks were to offer a promotion or discount, okay, when people used to wait for this, it could be a 5 ringgit discount. It could be a buy one free one promotion. You will have a long queue. Okay, you'll have to wait for half an hour before you get to the at minimum before you get to the counter. That's how bad the queue used to be. Okay, so something like that shows people go crazy over when people go crazy, that's when you know that people are price sensitive. Okay, so I don't know about profits. I cannot answer that. But in terms of revenue, definitely you're going to make a lot more money if you offer a discount when a product is elastic. Okay, now let me go back to the calculations for a second to explain why I'm saying it is elastic. Okay, so if you can see at the top and at the bottom before we go to the middle, the price first. The calculation is old price minus new price. Sorry, new price minus old price over old price. So that's what the new price is 10, old price is 15. 10 minus 15 over 15, you get negative 33.3%. Same thing for quantity at the bottom of the screen. Previously, they were selling 40 cakes. Now they sell 60 cakes. New quantity minus old quantity over old quantity times 100. 60 minus 40 over 40 times 100, you get 50%, and it's positive because I'm now selling more cakes. So obviously, it's a positive figure. Okay. Please maintain the signage when you are answering these questions because it's very, very important. I'll come to that in a bit. Now, I plug in the values according to what I'm seeing in my calculations and follow the formula. The formula is percentage change in quantity demanded. By how much did it change? 50%. Over percentage change in price, it changed by negative 33.3%. I divide that. No need to multiply 100 again. It's already in percentage form. Give you negative 1.5. Why negative? One is a positive, one is a negative. So when you come to calculating price elasticity of demand, you will actually see that most of the time, in the case of a normal good, okay, you will see a negative figure. And that's what we normally observe. When price goes up, less people would buy. Price comes down, more people would buy. So now the price has been discounted, so more people are buying. The negative or positive signage just tells you the relationship between the two factors, which is price and quantity demanded. Okay, so negative 1.5 merely shows that there's an inverse relationship between the two factors, price and quantity demanded. When you are evaluating is the product price sensitive or not, you look at the number. Whether is it more than 1 or less than 1. So 1.5 obviously more than 1. So this is not a maths situation where we're saying negative 1.5. We don't read it in that way. We don't read it mathematically. Okay. So 1.5 tells me it's elastic, and that's why I said what I said earlier. Okay. The firm will make the option B now. The firm will make more profit because the sales have increased. And this is again why I said you don't take answer more profit. More revenue, yes. More profit, I don't know. Okay. Price elasticity is inelastic because demand only increased by 50%. No, it's elastic, right? And we know this after we do our calculations. Excuse me. Now, this is where I find the question a bit funny because 1.5 tells me that the product is elastic. And I got this from calculations, right? But when you do calculate the revenue, okay, the way to calculate revenue would be price times quantity, just a simple calculation. So if you see in the first situation, at $15, we sold 40 cakes. Second situation, at $10, we sold 60 cakes. So how much revenue, how much money came into the firm? Revenue and profit is different. Revenue is how much money comes into your firm, comes in after sales, due to sales. And profits is whatever is left after you have deducted your costs, after you have deducted your expenses. That's the basic difference between the two. Okay. So when you sold $15 at $15 and sold 40 cakes, 15 times 40, your revenue is 600. Okay. And when you reduced it to 10, you sold 60 cakes, which means that you also have a revenue 10 times 60, you also have 600. So if this is the case, regardless of price change, you're having the same revenue. That's when you have what we call a unitary elastic situation. Unitary elasticity means you don't have to bother changing the price because you're going to get the same revenue irrespective of what happens. So this is one of those rare situations where you have, it doesn't really matter whether you have a discount or not. Makes you sound good, but it doesn't really help your business in any way because it does not increase the revenue. So this is where I find it a little bit problematic because the calculations in the PED shows me 1.5, but here in option D, it tells me that it is having unitary elasticity. But anyway, we're not here to argue with the examiner. We're just merely here to select our options. So A, B, and C is wrong. D for delta. That's your answer for this one. Right. Market failure. Number 8. A major oil leak in 2010, a major oil leak from an oil rig affected many people living around the Gulf of Mexico. What type of market failure did they experience? So in this case, market failure, if you remember what we discussed earlier, it's dealing with optimal output. Okay. There are different types of market failures, and a few of them are listed in your textbook, right? because we don't need to go through that many. But the main ones that you really need to concern yourself with would be negative externalities, positive externalities, as well as monopolies. Yeah. So monopoly exploitation, option A, tells you that there should be only one oil rig. The question said a major oil rig. Sorry, major oil leak from an oil rig. Did they say it was the only oil rig? No. Okay, so that's one. Secondly, they are not showing us how the oil rig has exploited people in terms of production or in terms of price. For you to say there's monopoly exploitation, you have to illustrate a situation where not everyone is getting the oil, or not everyone can afford the oil because of the price. It's too high. Then you can talk about monopoly exploitation to an extent if it is the only or if it is a major producer. Okay. Negative externality, yes, because the oil rig has affected other people. The oil rig made a mistake and there's been an oil leak. But it's now not just the oil rig's problem. It's not just the oil company's problem. It is also affecting the people living in the Gulf of Mexico. Okay. So the oil leak has caused maybe the fish in the sea to die. So fishermen are now having a problem. It has caused maybe people not to be able to go scuba diving. So tourism and hotels are now affected because of the oil leak. You can say that the water is polluted. You can say, anything. As long as someone is, earlier what we saw was a positive spillover. This is a negative spillover. So that would be negative externality. Okay. It could cause you more cost in having to clean up what was there. Now what has happened? Okay. So that's negative externality. It harms the environment, harms people, harms animals, harms tourism, whatever. Doesn't matter. Okay, as long as it harms someone else who was not part of the decision. Obviously you didn't decide to leak the oil, but still. Okay. That becomes a negative externality. Price discrimination has not been highlighted in the question. We do not have any scenario discussing this in this particular question. But to explain, price discrimination is where you have different groups of people who are needing to pay different prices. So for example, if you go to the cinema, you might have, if you're a student, maybe you might get a cheaper ticket because of a student discount. If you're an elderly person, especially in Malaysia, you can claim a certain discount on your movie tickets. If your ticket is being sponsored, you might, or your ticket is being, if you're like Maybank, for example, certain banks would give you a discount on movie tickets. Then the moment you have different groups of people paying different prices or enjoying certain privileges in terms of prices, then you have price discrimination. Okay, of course, it's meant to, and you have a segregation of different groups of customers. Okay. Rising tax burden. This has not been discussed in the question. There's no issue on tax, so we're not going to go through that one. Okay. B, beta. Right. What changes would move the equilibrium in the diagram from point X, you are currently at point X, to a new point within area Z? Okay. So this is just a question of how do you shift your demand and supply curves to accommodate area Z. So if let's say you have the demand curve now, the one in blue, shifting to the right, that would refer to an increase in demand. If let's say there's a decrease in demand, you would be shifting towards the left. That doesn't help us at all. Yeah, because if it's shifting to the left, we are even further away from area Z. So has to be either C or D, increasing in demand. And the green line now, supply curve, if that shifts to the left, that's a decrease in supply. Anything shifting to the left is a decrease. Anything moving towards the point of origin is a decrease. Anything moving away from the graph would be an increase. Okay, so the supply curve is decreasing, going to the left. If the supply curve were to increase, it will be shifting towards the right. Look at the supply curve, and then if you imagine, or if you can just sketch that on a piece of paper, supply curve shifting to the right, you're going away from point Z. So it doesn't help us in this situation. So the answer in this case is C, Charlie. What is likely to cause wages in an occupation to be high? A low level of responsibility. Now, we don't need, so that's why economics is called a social study, isn't it? Because if let's say in any firm, right, you are a junior executive or a blue collar worker, generally the level of responsibility attached to these type of employees is very, very little. Yeah, we don't expect them to stay late. We don't expect them to do a lot of work. We don't expect them to take on a lot of tasks other than what they're employed to do. So workers who have a low level of responsibility would generally not be paid very much wages. Okay, so a low level of responsibility means wages are low. High unemployment means that people are desperate for jobs. So when people are desperate for jobs, you could be very, very well qualified. You could be definitely slotted to earn a lot more than you're supposed to be earning. But when you're in a situation of where people are desperate for jobs, you take the first thing offered to you like a dying man for a glass of water, right? So in this type of situations, high unemployment, firms would easily dish out very, very low salaries, and there would be many people desperate to take them. Okay, so high unemployment is would refer to low wages because people are desperate to get jobs. Pleasant working conditions. Now, this one usually would refer to high-end offices. It's very odd to think of an office which says that, okay, the CEO's room is well decorated. Executives' rooms have got carpets, but the rest, everybody else has to sit on the floor. There's no such office, right? So pleasant working conditions would refer to people generally getting paid high wages, but it's not a cause. I don't pay you extremely high salaries and then say that's because our office looks nice. No, it doesn't work in that way. Okay, so it's a fact it can influence, but it's not the sole reason. Okay, now the need for special skills. This is where not very many people would have these skills. So as a compensation, because we know not many people have those skills, you might pay that employee a lot more wages so that the person is loyal to your company. They don't easily leave, so on and so forth. Okay, so not many people have those skills, and because of that, they can demand for higher wages. Okay, D delta. A trade union negotiates a basic weekly wage for its members with all employers in an industry. In addition to the basic wage, one company also operates a production bonus at a factory level. Okay, what's the aim? So objectives of the firm. You're giving a basic wage, and now you're saying that there's a production bonus. So the moment that there's a bonus, is your aim to give equal wages? No, it's not possible, because now you're trying to invite workers to perform better. And if they perform better, you're going to reward them with this bonus. So the very fact that there's a bonus means not everybody's earning the same thing anymore. Okay. To increase the efficiency of the workers, maybe, because now you're trying to get people to perform better. And again, there's a lot of other, there's a lot of theories on how to motivate your workers, right? Some are monetary, some are non-monetary. But in this case, the fact that there's a production bonus is that workers will actually work very, very hard in order to qualify for that bonus. So it's a win-win situation. You as a firm see good production, high production, good quality production. And as the employee, they are rewarded at the end of the month when they get their bonus, okay, which is a monetary compensation. To introduce a minimum wage, basic weekly wage is not a minimum wage. It's not the same, but the idea there is it's very similar idea. So I kind of it's not accurate to say that it is the same, but having a basic weekly wage means that everybody is paid that minimum amount, the basic amount. Yeah. So in that sense, it is equalized, but that's not the aim of the firm, evidently, because now the production bonus has come into play. And then to reduce the total wage bill can be reduced because now you are introducing, you're having a basic wage rate, one. Secondly, you're having the bonus which has come into play. So it's not this, it doesn't seem that you're trying to reduce the expenses. Okay. B beta. 12. what might cause a rise in the proportion of income that a person saves. Whenever we get income, we do two things: we spend or we save, right? So if there's a fall in interest rates, and this is a question I get in class all the time. So they'll always ask, like, Miss, is this interest rates for saving, or is this interest rates for taking a loan or credit cards? And my answer is it's the same. It operates the same way, strangely enough. If, let's say, interest rates are lesser, you will not save more. See, because as a consumer, your job is to do your job is to achieve maximum satisfaction, whether it be through discounts, whether it be through buying things, whether it be through um buying different things, right? So if it is profitable for you to save, you will save. But if, let's say, you don't get very much through savings, you will achieve more satisfaction with your money by actually spending on things. Okay. So if, let's say, you only get 0.2% by saving, you'll be like, oh, why would I save? It almost amounts to nothing. I might as well go and get something and be happy. The reason why I save is so that I'm generating a lot of interest so that I can have more money in the future. But if it's not going to do that, what's the point of saving? Okay. So and the same thing comes with, to explain it, the same thing comes with spending. If, let's say, there's a loan being offered and very, very low interest rates, you would not save, you would actually take the loan. Think of yourself not as a person for now, think of yourself as a business. If you need to open another factory, you need to buy another lorry, for instance, you would find it, you would want to save money because you want more money for the future. But if right now it is easy for you to take a loan and achieve other things, to buy a new plot of land, to renovate your factory, to buy another mode of transport to deliver your goods, why not? It actually makes more money for you than saving at a very, very low, insignificant rate. Yeah. So it operates the same way. Okay. Save less. A fall in population. Fall in population doesn't actually affect the amount that, if there's more people or less people living in Malaysia, doesn't really influence how much I would save. Not directly anyways. It can eventually impact, but it doesn't cause me to save more or save less. However, what it does mean is that there are less people in Malaysia who are saving money because less people exist, not because it has influenced me to save less. Okay. A fall in real incomes. Again, it doesn't affect how much I would save, but it means that if at all, maybe if say a fall in real income actually would mean that I've got less disposable income. Okay, so I can argue it in this way. There's less disposable income for me. So when there's less disposable income for me, money becomes tighter. Am I not right? So when money is tighter, yes, the logic would be to save money because, yeah, tomorrow I may not have enough, that kind of thing. But right now, it's not the situation of you not wanting to save. You can't save because you got less disposable income. So let's say you used to be earning 1,000 ringgit a month, but now you're earning, and say your expenses are about 700 ringgit a month. Okay, so formerly you were able to put aside 300 ringgit for savings. But now let's say that you are only earning 800 ringgit. Firms are cutting down, firms are downsizing, whatever. So say that the firm now pays you only 800. You don't really have a choice because everybody is downsizing. Okay, so firm is now only paying you 800. Can you save 300? Can you be stubborn as like, no, I want to save 300 ringgit? You can't because your expenses are 700 ringgit. So you can only save 100 at very best. Okay, so there's less money to save. A fall in the income tax rate, however, would mean that you have more disposable income. When you have more disposable income, there is a tendency that you might actually increase your savings. Possibility. You might actually spend more, you might save more, but either ways, there is a tendency for you to save, to be able to save more than you used to. Okay, last time maybe you could only put aside 50 ringgit for savings, but now because taxes are reduced, you don't have to pay so much to the government. So maybe you're able to save 200 ringgit and not just 50 ringgit, something like that. Okay. Number 13, for anything to be used as money, it must be. Okay, so there's some characteristics of money, characteristics that must be there for something to be recognized as money, if you remember. Okay. Fixed value is not one of those. If money has a fixed value, that's quite dangerous, and that is only done in situations when the economy is really, really in a dire state. All right. So if that were to happen, then it's usually when the money is crashing. Okay. If you go back in history, different countries have experienced this at various points of times. Malaysia, we saw this in 1998 when the ringgit was crashing, right? Because of the world financial crisis. So the prime minister at that point of time fixed the value of the money, pegged the money really, and that we study it under exchange rate. So I won't go too much into that now. But no, it is not the cardinal rule of something being money. It must be in fixed supply, also very unhealthy for an economy if it is fixed in supply. If it is fixed in supply, you would see, you got to think of your country as a balloon. Okay, that's the easiest way to think about it. So a balloon can expand. It can also collapse. So, and how much it expands or how much it collapses really depends on how much air is there in the balloon. So think of money as that air. The more money that you pump into the balloon, the more money that you pump into the country, or the more air that you pump into the balloon, that would be that would see how much the balloon would expand, correct? And same thing for a country. That's how much money is circulating in the country, shows the number of transactions that are going on, the number of businesses that are opening, the amount of buying and selling, GDP, production, all this. It's very indicative of all these activities in an economy. But again, you cannot over pump the balloon. You cannot over pump the country, right? So if there's so much money that's in the country, there will come a point of saturation because there is a capacity, and we do that under GDP, isn't it? So there is so much of capacity only that a country can hold. There is a point of saturation, and if you reach that point of saturation, what happens is that it becomes stagnant. Okay. So that when you talk about money being in fixed supply, you cannot see that buoyancy, you cannot see that activity, you cannot see progress or regress, or you cannot experience the ups and downs of an economy if money is going to be in fixed supply. Again, that only happens in a very, very dire situation. Okay, whereby you want to fix the amount of supply that is there. If at all, money can be in fixed supply theoretically, in certain, if you think of it as accounting periods, so to speak, in a country, Q1, Q2, Q3, Q4, you may want to have or you may want to stick to as close as possible that particular supply in that particular time, maybe. Okay, but again, it's not a cardinal thing that must be fixed. It's not a matter of principle that supply must be fixed. Okay, and it should be adaptable. Legal tender, okay, this is the reason, this is something that we discuss after. Once something qualifies as money, it must be legal for you to use it as money, but it's not the preliminary factors. So it's the same reason why I hold up a monopoly note. You would not take it in exchange for goods and services, because you take one look, you already know, okay, that it's not, you know also that it is not, stamped by the government of Malaysia, that, it is not acceptable to trade with. Okay. And bear in mind also that at certain points of time in history, we have had situations where money is no longer money, right? Say in, and this happens in very, very dire situations. Yeah. So for example, in World War I, okay, where money ceased to have value, cigarettes were traded among soldiers. Okay, there was no business for money at that point of time. You're in a war. Okay, so there's no banks for you to go and withdraw There's no QR codes for you to go and, obviously during World War One. But or if you say between little children, say kindergarteners, right? I have a bar of chocolate, you have a box of biscuits. So let's trade. You give me that bar of chocolate, I'll give you the box of biscuits. Yeah, you understand? So it's not necessary that money can exist in various forms and not just the notes and coins that we use. Okay. Readily acceptable. Money, whatever qualifies as money, it must be generally and readily acceptable. Okay. Same reason I was speaking about the monopoly notes just now. You take one look, you'll be like, that's not money. Okay. So, but in the case of the chocolates and the biscuits, which I said earlier, that's readily acceptable if it is between two people who are willing and able to trade. And that's why that's also one of the reasons why we stock barter, isn't it? Because not everybody would want that bar of chocolate, or they'll say, I need 2 bars of chocolate because this is a big box of biscuits. Yours is a small bar of chocolates, right? So, but otherwise, notes and coins, which we normally talk about, it must be recognized as money for me to accept it. See, that is why, say, for example, if you tour in certain countries in the world, they would accept US dollars. They would also accept the currency of that country, especially in major cities. Yeah. So, why would you go to, let's say, Greece and trade in euros? Why would you go to, let's say, say the Philippines? Let's say you're a Thai citizen and you go to Philippines and you're like, okay, I've run out of Philippine currency. So I've run out of, okay. So I only have US dollars. Can be accepted in major cities. Okay. Even though you're not a US citizen. So, or you're not coming from the US, you carry American dollars, it would be accepted. Why would I do that? Why would I accept US dollars if I'm a Filipino trader? Why would I accept US dollars? Because I look at the money and I know that is legal tender. I know that is actual currency. All right. So it must be acceptable for me to use it. All right. So if it is not readily acceptable, we don't discuss all the other characteristics. Okay. Number 14, you have got 2 workers, you have got doctors and window cleaners. And here we are talking about issues of saving and spending again. Both workers are saving 10% of their disposable income. First and foremost, you got to understand what's disposable income. That is the money that you have that is available for expenditure or savings. All right. So if you look at your if you go to your if you see what your parents earn, they have got gross salary and they have got net salary, isn't it? So gross is whatever is stated on their offer letters. Say I'm going to work now, and it says on the offer letter I'm earning 2,000 ringgit, for example. Okay. So and then this is just an example. It's definitely not applicable in real life. So say 2,000 ringgit. And say there's tax which is applied. Okay. Or if a person is taking a loan or something, the banks may do automatic deduction. Right. So let's say at the end of the day, the person has got 1,500 ringgit that enters the account. Right. Nowadays, workplaces, I think they do us a favor and they deduct the salary for us before we actually get our money for the month. Yep. So what is left in our account is whatever it's up to us how we want to spend it or save it. That's in our discretion, correct? So because of that is known as disposable income. So here you have the doctor whose annual income is 50K, window cleaner, his annual income is 20K, total deductions are 10 and 8K respectively. So that means the doctor now has got 40,000 to spend annually and the window cleaner has got 12,000 to spend annually. Now both of them supposedly save 10% of their disposable income. So 10% of 40,000 is 4,000 and 10% of 12,000 is 1,200. The answer is D delta. Okay, quite a straightforward question. Which one of these is a diseconomy of scale? So if you remember, we want firms to expand, right? In our syllabus, we spoke about the importance of a firm expanding, right? And also we do speak about the importance of small firms. But when a firm expands, one of the main purposes is to experience economies of scale. And that just talks about how you are able to lower your cost of production per unit that you are producing. Okay. It is also possible for you to actually expand too much or too fast, and then the firm runs into trouble. Or during expansion, there can be sometimes teething problems where you experience diseconomies of scale instead. Okay. So if you remember your U-shaped graph, right? Coming down the U would be economies of scale. Going up the U would be diseconomies of scale. So you're increasing your production, yes, but you are somehow or rather experiencing more cost per unit. Okay. So bulk buying reduces cost. That is an economy of scale. That is actually bulk purchases and purchasing economies. Okay. So you're coming down the U. Communications deteriorate. So say, for example, that your firm is expanding. If you remember the game Whispers, right? So you whisper something to the person, the next, and it goes down a chain, isn't it? You whisper something to the person in front of you, they whisper to the next, whisper, whisper, whisper. It goes down the road. And the person at the end of the line is supposed to say what exactly they heard. By the time the message goes down the road, it has got distorted so badly that more often than not, you hear a completely different story from what you said in the first place. Okay. So that is where you have communications deteriorating. Now you got to translate that for a firm. Why is this an issue? Why is it a problem that if you get wrong instructions or you mishear instructions? Okay. You might have to redo the product. You might have to throw away whatever you made. You might have to make amendments or changes. You might have to, get your workers to stay overtime. All of this involves more money. Whether you're throwing away, whether you're making adjustments, whether you're asking your workers to stay overtime, starting afresh, whatever it is that you're doing, it means more money, wastage, right? And that, even though you're producing more, you're producing another one because you're making an adjustment. You got to throw away the old one. You got to make a new unit. You're producing more, but you're not helping the firm. You understand? In fact, you're adding more costs. You're not helping the firm. So this usually happens when the company is expanding, when the boss issues instructions. Not everybody gets the same instruction. Everybody hears different things, right? So that can happen, but it also means that you are adding more costs for the company. Employees are more motivated. Productive employees are happy employees. They generally find good methods to reduce cost of production. Okay, so higher productivity is usually coming down the curve, economies of scale. Technological improvements take place. The whole idea of incorporating better technology is that you have more efficiency. You can produce faster. You can produce more. Again, all of this just translates to more production on a better scale, right? And technical economies is economies of scale, coming down the U again. Okay, so the answer is B, beta. The financial director of a company adds up the cost for a firm. Now look at what they're adding: rent, insurance, new machinery, and the chief executive's basic salary. That's probably the one that would throw people off target. Okay. The director divides that by the total, by the firm's output. Okay, what has the director calculated? So you need to see what they're actually looking at. See, rent, insurance, new machinery, something that you might be taking a loan for, you might be paying the loan, or you have to pay monthly, or something that you have to pay irrespective, or you might be paying bulk, doesn't matter. And the basic salary. Now look, whether or not your company actually produces anything, you have to pay this every month. You got to pay your staff, whether you like it or not. You have to pay for the machinery, whether you're paying on installments or whether you're paying upfront, doesn't matter. But it doesn't matter that you have not made anything. You still have to pay for it. Insurance. They don't care whether you have actually made a profit, whether you have made any money, they don't care. You got to pay for the insurance every month. Rental, you got to pay for that every month. They don't care. And that's also a lot of reasons, if you remember, during the lockdown, where firms ran into problems because they had to pay the banks, even though that they were not actually making or selling anything at that point of time. Okay. So when you have to pay for something, whether or not you make and sell anything, that counts as fixed costs, right? 1. If you look at the options here, A, B, C, D, they don't have fixed costs. Why do they use the word average? Because it says here in the question that the amount has been divided by the firm's output. When you divide something by the output, on average, that's how your final figure. Okay, average fixed cost, average whatever. So fixed cost divided by output gives you average fixed cost. Obviously, revenue, no, because these items are not revenue, they're not earnings. Total cost we cannot discuss because we do not know any variable cost. They have not actually given us the figures for variable costs, and none of these things are variable. Same thing for D, none of these things are variable, so D is definitely out. The answer is A, alpha. Amit and Pardeep have set up in business together. Each has half of the shares in the business and limited liability. What type of business organization? So types of firms, yeah. Now, what would throw a few people off course would be Amit and Pardeep setting up in business together. This looks like a partnership. It is not. Why do we know it is not? Because if you look at the second sentence, we're talking about shares. We're talking about limited liability. Okay. So the moment you talk about shares, it can either be public or private. Fortunately, they did not say anything about a public limited company. Okay. Furthermore, why do you know for sure this is not a public limited company? Public limited company, shares are sold to the public. But in this case, half the shares belong to Amit, half the shares belong to Pardeep. So there's no public element in here. So the fact that you talk about limited liability also refers you to a private company. So there's no element of cooperatives in here. Private company because both of they set up the business together, both own half the shares. That means you can only sue them if anything goes wrong. You only sue them for as much as they have invested into the firm. Okay, as much as they have invested into the company. You cannot go and auction their house. You cannot touch their private cars. You can't do that. Yeah, because that's a limited liability. That's what limited liability protects you from. Okay. Table shows a firm's average revenue and average cost. We want to know profit. So for you to calculate profits, the formula is just revenue minus cost, which gives you profit. Here you have average revenue and average cost, so it's just a simple deduction, and then all you're looking for at the end of the day is the largest margin. Okay, so which level of output gives you the maximum profit? If you look at A, 10 minus 30, you get negative 20. B, 20 minus 20 gives you 0. So kind of, I won't use the loosely, I'm just going to say break even. 25 minus 15 gives you a profit, but it's 10. But if you look at D, 30 minus 18 gives you 12. It's a slightly larger margin. So that would be the answer. Perfectly competitive market, if it becomes a monopoly, what is likely to increase and what is likely to decrease? So we discussed a little bit about perfect competitions and monopoly earlier. Perfect competitions is where it's a homogeneous product. It's nothing special. Say, for example, there's this thing called drop shipping. Okay. Now, for some time, sellers from India, what they would do to push out mass-produced saris, mass-produced material for stitching, they would actually get people around the world, and largely Malaysia. Malaysia has got a large market for this. They would invite anybody, and it's a wonder how they get hold of your numbers, really. But they would contact you and say, look, I'm a seller. I sell such and such a thing. Would you be willing to sell on my behalf? Now, you don't need to register. You don't need to do anything. All they need is your number. What they would do is they would actually pump, daily they would send images of what they're selling, and they would give you a so-called discounted price. Okay, so if say normally the sari would cost you 100 ringgit, as a seller, you get the privilege of obtaining the sari for maybe 50 ringgit or 80 ringgit or whatever. Okay. And your job is merely to add, yeah, you could buy it. And if you buy it, you definitely are getting it at the discounted rate. But your job would be to actually put up these saris or to purchase these saris at the discounted rate. Of course, if you are buying further in bulk, that's a different separate arrangement. But anyway, your job is to advertise, and whoever sees it of your social media or your WhatsApp chats or Telegram chat groups, you get a customer. So basically, you become like a middleman, just doing the job of advertising. You don't hold the products unless you wish to. You don't hold the products. You don't have to pay any fee. You don't do anything whatsoever. Your job is merely to act as a middleman, to advertise and to sell. Now, in order to do this, sometimes a group can have as many as 300 or 400 sellers. And bear in mind that if you join enough groups, you would have the same different sellers giving you the same products at different prices. So from there, you kind of figure out, okay, who is giving you to you at a cheaper price and a cheaper, so that, because if you get the sari at 50 ringgit when the original value is 100, and I promote it on my social media and say, oh, okay, I don't tell people what I'm getting it for. So I say, okay, this sari is being sold at, say, 70 ringgit, and somebody buys it off of me. I make a 20 ringgit profit. And that's mine to keep. I merely remit 50 ringgit to the seller as what was promised. He doesn't need to know, and he doesn't care how much I sell it for. That's my business. You understand? So when you have so many people, 300 sellers in this group, 300 sellers in that group, 300 sellers in another group, and all of them are getting the same product from different sellers in India, and imagine if all 300 are selling. Is it easy to enter the market? Very easy. All right. So perfect competition has a very low barrier to entry. So if you become a monopoly, though, you're the only person in the market. Now, would you dare challenge, say, Disneyland? Disneyland is well known. It is huge. Okay. To take on somebody like Disneyland and take them down, just an example, that would require massive influence, massive amount of money. It's not something that just any random person would like to do. Not a newbie on the market anyway. Okay. So barriers to entry, that is a barrier. Would you take down Disneyland because of their name, because of the cost? No, very few people would do that. Okay. Or it will take you years before you actually achieve something close to what Disneyland has achieved. Okay. Even if you set up a very beautiful theme park. Okay. So if you are becoming a monopoly in terms of name, in terms of size, in terms of cost, barriers to entry would increase, definitely. Economies of scale, though, would increase as well. Because now, as a monopoly, you are the sole seller. Everybody has to come to you because you're the only one on the market selling this thing. So your production would increase because you're selling to so many people. And when your production increases, you will find eventually your cost of production per unit would reduce. Right? Profits would increase, definitely. That goes without saying, because everybody comes to you, right? So that goes without saying. Competition would reduce, though. Okay, because you're a monopoly, right? So you're a monopoly for a reason. The number of people who exist would be, the number of competitors who exist would either be insignificant or none. Really depends on the situation you're talking about. Output would definitely increase because, again, same thing, you're selling to many people. Market share would increase. Okay, because to be a monopoly, you need to own 25% of the market for you to qualify to be known as a monopoly. Okay, so market share would definitely increase compared to being a perfectly competitive person. You would own like a very tiny, insignificant share. Think of those many sellers selling the same sari. Okay, consumer choice. Consumer choice would decrease because they don't have anyone to buy from. They can only buy from you. Okay. Prices would increase, though, because you're the monopoly. they don't have anyone else they can buy from. Okay, so they can only buy from you. Right? So you would be brave enough to charge them anything that you wish to. Okay. So with that, B, beta. What would be most likely to reduce the rate of inflation? Okay, so first and foremost, inflation would be prices in general of all goods and services increasing. Okay. Yeah, general prices of all goods and services increasing. So the question is, how do we take control of this? How do we reduce the pressure on prices? Basically, inflation, if you think about it, is just basically pressure on prices. Prices are being pushed up, and the question is why? Okay. Now, in this case, how do we actually take off that pressure? If, let's say, there's an increase in direct taxes, what will happen is that, remember we discussed earlier, that the amount of disposable income would reduce. Okay, so when the amount of disposable income reduces, you have basically less money supply in the economy. So if you remember, I spoke to you about the country like a balloon. Okay, now when you have too much of money supply in the country, that pressure on the balloon is there. So think of that pressure of that balloon, the balloon being your country. When you take away the amount of money that's circulating, you're easing the pressure on that balloon. It's still round, it's still big, but you're not imposing huge pressure on that balloon. Yeah. So less money supply, that's one. An increase in government expenditure. Now, there are different ways, like I said, that you might experience inflation. There's demand pulls, cost push, and also you've got your monetary inflation. So under demand pull, you've got different causes. Same thing under cost push as well. Now, under demand pull, you've got your consumers who might be demanding for many goods and services. So they might be overspending, and putting pressure, pushing money into the economy when they could be saving it. You could have firms who are crazy expanding. They want to just be the next Amazon. They want to be the next Facebook. They want to be the next Walmart, whatever. Okay. So they are trying to expand. That's investment. You also have the government who might be pushing in expenses in their own way, not because they are profit motivated, but because maybe they want to, they might be setting up a government hospital. They might be building a road. So they might be pushing money into the economy to get this going. Right? It's for welfare purposes, yes, but still, nonetheless, it still involves money being pushed into the economy. So if there's an increase in government expenditure, that's going to be releasing more money into the economy, that's going to increase the rate of inflation. So if you see down here, I put aggregate demand goes up and therefore demand pull inflation goes up. An increase in indirect taxes. Now, this one operates a little bit different from direct taxes. Indirect taxes are taxes which are charged on your goods and services, right? So you go to KFC, you buy your fried chicken, and at the end of the bill, you get a little government tax at the bottom there. So, which is added to your bill. You go to a restaurant, same thing. You go and buy, you go and stay in a hotel. You are charged, service charged. Okay, those kind of things. So any of those taxes add to your bill, which is pushing up the final price that you're paying. So you could have paid 15 ringgit at KFC, but now you end up paying 20 ringgit because of the tax which is imposed on you, isn't it? So the final price is being pushed up. Yep. So that would be cost push inflation, because the tax is imposed on the firm as well. We only see what we are paying on the bill, but even the firm does have to pay a certain amount of tax. So when the firm has to pay that tax, usually the firm would push some of the tax to the consumer and push up, or even if they absorb, they would push the prices of the product, final price, to be higher than what it should be, because they now bear the expenses of paying the tax. Correct? So, yeah, that's cost push inflation. An increase in the budget deficit. Budget deficit refers to your government spending more than what they're receiving. And it refers to the same thing as B, actually, an increase in government expenditure. Okay? So, A alpha. Why are schools sometimes built and run with government money? So they're asking, why are there government schools, basically. Private schools don't run with government money. The private sector could not afford the cost of investment to build the schools. This one is where you see, okay, but the government schools, it doesn't justify why we have government schools. Private sector could not afford to, the cost of investment to build schools. In fact, sometimes that is the whole reason um, why you have government schools. But it's still not the preceding factor. Okay. Also, if private sectors could not afford the cost of investment to build the schools, then you just don't have private schools. That's just it, at best. Yeah. The private sector would have lower standards than government schools. That has nothing to do with why you actually have government schools, and these schools still exist. Provision of schools by the government ensures the widest choice for students. Usually, government schools are quite limited because it's run with the welfare in mind. It's being run with government money. So usually, just the basics are there. You've got your basic subjects, you've got your basic amenities, you've got a school hall, you've got a school library, you've got staff room, you've got, all these things are there. But it is not well endowed, unlike private schools. Okay. And then the external benefits from the provision of education, that is the purpose of having government schools, isn't it? Because if you go to rural areas, no private school is going to set up there because nobody can afford to pay those fees, isn't it? So the job of the government is to ensure that everybody has access to education, access to medical facilities, so on and so forth. So that is external benefit. I build something, someone else benefits because of me. So the government is building the school, but there are other people who are benefiting because of that school. And when you have educated workers, then it goes on to the next bit. When you have educated workers, the output is definitely better. The output is definitely of higher quality and so on. Okay. And remember that education still counts as merit goods, which is why you are talking about positive externalities. Okay. The changes in demand mean that the government of Bangladesh hopes to switch some production from clothes made by low-paid unskilled workers to medicines produced by highly trained technicians. So you've got two things down here. You've got the clothes, and then now you're switching over to something which is entirely different, medicines. And the clothes, evidently, they're trying to say these are basic clothes because low-paid unskilled workers. So you don't expect very much. You probably look at standard clothings, mass-produced clothings. It's not nothing fancy. But medicines requires knowledge. You don't want the wrong person mixing wrong things for you. You might die. Okay. It's a different problem altogether. So you need knowledge, you need skills to make medicine. Yeah. To be a pharmacist. Even if it is a technician. Yeah. Now, which policies would enable Bangladesh to achieve the switch in employment and production? They're asking you, how do you switch from clothes to medicine? Okay. Closing the clothes factory does not help me to switch over to, it might reduce the clothes, yeah, but it doesn't help me to increase or start producing medicine. Decrease imports. I don't know imports of what, whether are you talking about imports of clothes or imports of medicine, but either way, if it is you're reducing imports of clothes, okay, it helps me to understand why there are less clothes. If you're reducing clothes or you're reducing medicine, it doesn't help me to understand why we're having more medicine now. Okay. Encourage immigration of foreign labor. Okay. So they didn't say what kind of foreign labor I'm having. They didn't say, am I having skilled foreign labor, unskilled foreign labor? They didn't say anything. So I don't know. That alone is not enough for me. I can interpret it either way. What I'm saying is I can interpret this either way. Introduce tariffs on clothing. Yes, this helps me to understand why tariff is a tax on imported goods though. They are not talking about importing the clothes. They are saying right now my country is producing clothes by low paid unskilled workers. that is not tariff. Tariff is if I'm importing the clothes and I'm putting a tax on it. Doesn't help me to understand anything here. Okay. Invest in, and also further, it doesn't help me to automatically switch to medicine. That's the main thing which I'm trying to get at. Invest in education. Okay, so that helps me to understand why unskilled now becomes skilled, because now these workers have got knowledge and they purchase new machines. So maybe once you have trained them, right? Because education can mean skill, it can mean technical education, it can mean skill based. So these workers now become technicians, maybe. So maybe they can start. And you see, they are hoping to switch some production. Not everybody's going to go to university. Not everybody's going to go to college. Some can afford it. Some don't want to. So some of these workers now go to college. They become educated. They now start learning how to make something new. Correct? So education helps to make them highly trained, and they have machinery to facilitate this. Obviously, a lot of medicine requires the aid of machinery, right? When you produce your pills and your tablets and all that, you need machinery to help you, right? Okay, so that's that. Substituting labor for machines doesn't automatically help me, but okay, I can understand something there. But either again, it doesn't explain. If you go back to the question, they're hoping to switch some production from unskilled workers to, technicians. Is it to a highly trained technician? So, you still want workers. It doesn't help to explain that part of it. Encourage emigration of workers from Bangladesh. Emigrating is you leaving Bangladesh. That doesn't help me to understand why now you're becoming trained and why you're producing medicines. Okay. Furthermore, the technicians actually are using machinery. They're not being substituted for the machinery. Okay. All right. Now you have this one. They're having a tax system where they say incomes below 5,000 is not, they're not paying any tax. So automatically you should know B, C, and D are wrong. B, C, and D show you, B shows you some tax is being paid at 5,000. C shows you rising amount of tax, zero income, no tax, and then it rises from there. D shows you the tax actually reduces until you reach $5,000. So no. So basically that's what's happening here. If you can see the yellow highlight. Proportional on incomes between 5,000 and 10,000. So proportional means, a flat rate. So if at all another option that, A, C, and D show you where you're having proportional tax between this and this amount. And then they say it's progressive. Progressive means the more income you earn, the more tax you pay. Anything above 10,000 is progressive. So it needs to be hiking upwards, and that only appears in A and D. So the only one that fits all three categories is A. The answer is A alpha. Okay. Number 24, between 2009 and 2010, an economy grew by 2.1%. What is most likely to have increased during this period? Economy growth refers to you doing better, you earning more economic activity, more GDP, more production, whatever. Yeah, more skills, more knowledge, more everything, right? What is most likely to have increased during this during this period? Population, no, because if you look at the formula, when you calculate when an economy is doing well or not, it's GDP per capita, which means GDP per head, GDP per person. And if you look at this formula, GDP over population divided by population, simple maths. 2 divided by 2 gives you 1. 2 divided by 4 gives you 0.5. So if population grows and GDP does not grow, it doesn't show me why my economy is growing by 2.1%. Production, that's your GDP. If you go back to that same formula, GDP over population. So GDP refers to the production of the country for the year, production of goods and services. So if GDP grows, so again, simple maths, 2 divided by 2 gives you 1. 4 divided by 2 gives you 2. So if production grows, you have economic growth. Unemployment. Unemployment means your resources are idle. It doesn't show me why my economy is actually growing. Wages, maybe it might be motivating, but it doesn't, it adds more cost. It adds to inflation. It doesn't necessarily mean my economy is going to grow. Okay, so that it doesn't help to explain everything fully. Yeah, it's not the sole factor. All right, 25. The government has a target of keeping inflation between 2 and 3%. That's the gray box that you see in the chart, the inflation target. Okay, so inflation is it can be a good thing. It's not always a bad thing. We always say we always don't like when prices go up, but sometimes it can be a good factor. Okay, and that again, that's a big discussion by itself. So we won't go into that for now. We just need to interpret this chart. Okay, now look at A, the government target was missed in 2 years. If you look at the dots, year 1, year 3, year 4 are outside the target. So it was missed in 3 years, not in 2 years. The price level fell in 2 years. The only time, now please look at the axis. Okay, the axis on the vertical axis says percentage rate of inflation in terms of percentage. I won't go into that. I'll explain that separately in a different paper for that particular question. But if you look at the 4th year, in year 1, it says prices increased by 5%. Second year, it increased by 2.5. I'm just taking a rough figure. And in 1, 2, and 3, it shows us, and year 3, maybe approximately 4%. 1, 2, and 3, it shows us a positive change. That means the price has increased. But if you look at year 4, 1%. Actually, I'll go into that in the next explanation. In year 4, it has decreased by 1%. So the price level only fell in one particular year. That is for the 4th year. Now, going back to what I said earlier, year 1, it increased by 5%. Year 2, it increased by another 2.5%. That means if you can think of it as cumulative, over the years, 1, 2, 3, 4, you need to, the price would be highest in the 3rd year. It can't be highest in the 4th year because it actually fell in the 4th year. But it is highest in the 3rd year because it increased by 5%. Second year increased by another 2.5%. In the 3rd year increased by another 4%. So it was highest actually in the 3rd year, not the 1st year. Okay. The highest change probably was in the 1st year. That's about it. Okay, so be very careful with the wordings because that is where they would actually catch you on these questions. The real value of money fell in 3 years. No, the real value of money actually, you see, in where there's inflation, value of money falls. So if you look at year 1, year 2, year 3, you had inflation. Year 4, you had deflation. So yes, over 1, 2, 3, you had inflation, which means the value of money fell in the years 1, 2, and 3. Yep. Okay. Right. After more than 70 years of production, a German car manufacturer, Volkswagen, has decided to locate the production of its biggest selling car in developing countries rather than Germany. What is the main advantage of this policy? To access new management techniques. Okay, if you're doing business studies, this might be an answer, but it's not usually, it's one of the things that you probably want to pick up. So if you do business studies, you might have come across things like Kaizen techniques and all this, which manufacturers around the world picked up from Japan. Okay. Is it the main reason why you would produce in Japan? No. Aside from Japan, I'm sure every country has got its own technique, style, and skill that might prove beneficial for you to learn. But that's not the reason why you would take the trouble to go to a new country, to go and abide by the laws of that country, set up a new factory all the way over there, manage it all the way from over here. That's usually not the main reason why you do it. Okay, so advantage, but not the main one. To make use of better infrastructure. you could probably, again, same thing, you would, infrastructure usually refers to the buildings, refers to the facilities which are available. So maybe again, how different is it building a factory in one country from another? Probably another country has got cheaper labor, cheaper uh, cheaper uh no, maybe better equipment, better infrastructure in that sense, better roads, but it's not the main reason why you would actually open up there. Okay. Not so much cheaper labor, sorry, better roads, better transport systems and so on. Okay, but it's not the main reason why you'd shift production. To sell the car only to customers in developing country, that's cute, but no. Okay. Volkswagen is selling across. It's a good that they actually name Volkswagen because they're selling worldwide. Okay. Furthermore, there's no diversification mentioned in the question. They didn't say, oh, we are opening that particular car for that particular country. No, they didn't do that. Okay. To train and employ labor at a lower cost. This possible because you have people who are desperate for jobs. One of the, remember under the topic of multinationals, as a multinational firm, you may be able to offer a slightly higher salary to um, a worker there than one of the home country's firms. Okay, which is why a lot of people might actually do this. Either ways, for Germany, this is a very it's probably the best solution for them because then they can actually employ labor at a cheap cost and develop their production. Okay. What is usually a characteristic of a developed country, already developed. Okay, they're developed and developing. So a dependency on primary product exports, that's usually developing. You've got primary, secondary, tertiary, quaternary, sorry. So for a developed country, usually large tertiary, some evidence of quaternary because that's still not evident in most places. Secondary, largish. Okay, not that might be, but larger presence would be tertiary. High rates of economic growth. Now, a lot of students would pick this one, but see, you are already a developed country. You're already having very high rate. You're having a high level of economic development in the country, economic activity in the country. In a developed country, you're already reaching maximum. You're reaching saturation level. Okay, high rates of economic growth is where you're finding the scope to develop. In a developed country, you're still finding it. Yes, you've reached a saturation point, but that's why quaternary exists, so that you can find more scope for development. But high rates or rapid rates of economic growth would be developing, if not tiger economies. Okay. Low levels of productivity. And if it is low levels, it's usually because you don't have the skill and the expertise. So it is already quite productive. The difference between B and C, what I'm trying to say is that you are not you're not reaching, you're not looking for, you're not you're already at saturation point. You're productive. We are just trying to find even better ways of doing what we are already doing very well. Okay. Low rates of population growth. Yes, because in developed countries, people are pursuing their careers, they are pursuing they're educated on family planning. So you don't very often see families with 10, 15 children. So that's usually in developing countries, and that's for that had its own reasons really, because yeah, could be culture, could be lack of knowledge on family planning, could be okay, back when it all started, large families is because children usually did not survive infancy. But in a developed country, you have medical facilities to, make sure your kids survive and are healthy, right? So that is why in developed nations, we don't often see families with large numbers of children. Okay. 28, they are showing us two different charts. And so you can see down here that they're asking you again to interpret the charts. They're asking you between the two charts, 1950 and in 2010, What has decreased? Average age. No, if you see the age groups are the same, you still have 0.4, 0 to 4, right up to over 85. Okay, so average ages is still the same. Number of people below the age of 15. If you just add that up, you probably might see that the number has increased, even if you just take a rough look, right? Very mildly, but it has probably increased. Number of people over 60 has actually increased. And total population, sorry, my mistake. Number of people below 15, maths problem, sorry. If you do the calculation here, I was looking at the age of 15 to 19, sorry, where I made a mistake just now. That is probably the only one which has experienced an increase, 10 to 14, mild increase. But other than that, if you do a rough calculation, you can see from here, you can let's say just take for males, okay? 1.8, 1.9 is 3.7, 5.7, 5.9. And then you get in 2010, okay? 2.5, 2.2 is 4.7, 4.7, 6.7. So on male side, it has increased. But on the female side, it has actually reduced a little bit, isn't it? Okay. So yeah, you can see, especially from the 0.4, 0.24, sorry, that it has reduced. Or below 15. So you probably wouldn't even need to calculate the age group 15 to 19. You just take what exists below that, sorry. 1.9, 2.0, 2.2, you get 4.1, 6.1. Yeah. Okay. So take it from the three bottom categories. You would get a smaller figure. All right. Number of people over 60, if you see the yellow box, it has actually increased. Previously, due to lesser healthcare, lesser knowledge, less people were able to live longer, but now people are able to live longer with medical advancements and facilities. Total population overall, you can see the size of the charts between the 2 years. 2010 generally has got longer lines. If you're lazy to look to calculate, 2010 has got longer lines compared to 1950. Yep. So the answer is B, beta. What is an advantage to a country of free trade? Free trade basically is where you're able to trade freely, as the word says, meaning you don't have any restrictions. You don't have any laws, any rules, any regulations which are stopping you. Okay. So greater international diversification. Usually when you find that a country is when a country is able to choose what they want to trade in, because it's a free trade, right? You can choose what you want to trade, what you don't want to trade. You would generally pick what you're good at doing, which means you specialize. So will there be more diversification? No, you tend to specialize. Okay. A greater range of domestically produced goods. No, because you are specializing, you wouldn't produce everything. When you don't produce everything, you will have to import some things. So will you have a greater range? No. Okay. Because you just import what you're not very good at doing. Greater reliance on other countries, yeah, because you are specializing. Other countries are also specializing. You are now no longer producing everything. So therefore, you're dependent on trade. You're dependent on what the other person is actually making. Okay. But the question was asking for an advantage. This is a disadvantage. Greater specialization in the use of resources, yes. Okay. What we said just now. And that's an advantage, because why is specialization an advantage now? Because when you specialize, remember, you are focusing your resources, time, and effort on one particular or a few particular products, and whereby you waste less. So efficiency is there, productivity is there, and also quality would be there. Okay, so that's why specialization is an advantage. Last question, we're almost done. Right. The diagram shows the value of exports and imports of goods of a country in 5 years. This is a lot more fun doing this in class because everybody usually interrupts with questions and jokes along the way. Between which 2 years did the country have an increase in the value of imports and an improvement in trade balance? So what I've done now is I've actually just written down the value of the level of imports and exports for each year. So that's in maroon and purple in the screen. An increase in the value of imports, you got to go from year to year. And similarly, that's what's being done in the options here as well. Year to year, you need to see where imports have increased. So if you see year 1 to year 2, there's an increase. 2 to 3, purple figures here. 2 to 3, it has increased. 3 to 4, it's increased. It's only 4 to 5 where value of imports has decreased. So you can strike out D for that. Okay, there's no increase in imports. They also are looking at an improvement in trade balance. Trade balance is the difference between your exports and your imports. So you need to do a simple calculation. Okay, so I highlighted that in yellow, value of imports. An improvement in the trade balance. So if you can see down here, I just did that in yellow, bright yellow. The earlier one was in cream, right? If you can see the difference in year 1, the difference between export and import is 5. Year 2 is 2. Year 3 is 2. Year 4 is also 5. And the trade balance in year 5 is 8. So when you're looking for an improvement in trade balance, year 1 to year 2, trade balance has decreased, isn't it? 5 to 2. 2 to 3, stagnant, no change. 3 to 4, there's been an improvement in the trade balance because the difference has gone from 2 to 5. And also, value of imports has increased in those 2 years as well. Okay, so the cream color should exist for all, but yeah, so where it actually finds what I've actually done here is just to show you where the 2 years have actually experienced the increase. Okay, and with that we are done. As I mentioned earlier, I was rattling through, and it probably gets a little bit monotonous from time to time because this is not in a classroom setting, so you don't have people interrupting with questions and queries. What you could do, if there's anything here that has been unclear, please feel free to drop a message or leave a comment in the screen below. And please continue to subscribe so that I could actually share with you more papers and you would actually be notified once the other papers are uploaded. All right, thank you very much for watching this video, and I hope that it was helpful to you. Please continue to practice, and the same way that I wrote down the justifications, it would be good for you to try this on your own so that it would be helpful to you to remember the information that you need, and it will help you to actually solidify your knowledge. Okay, with that, thank you, everybody. God bless you, and I will see you in the next video. Thank you. Bye-bye.